Bank Negara or BNM has cut the overnight policy rates by 25 basis points to 2.50%, the lowest level in 10 years. This is the second cut to the key interest rate this year. The central bank had, in a preemptive measure, reduced the rate by 25 basis points to 2.75% in January. BNM said in a statement that the move is intended to support the projected improvement in economic growth. Last year, the Malaysian economy expanded by 4.3%. Looking ahead, BNM says growth, particularly in the first quarter of 2020, will be affected by the COVID-19 outbreak, primarily in the tourism-related and manufacturing sectors. Weakness in the agriculture sector is also likely to persist. Private and public sector activities will be supportive of growth, while the newly announced stimulus package should also help. Some economists are reportedly expecting another rate cut in May. During the global financial crisis of 2009, the central bank lowered the overnight policy rates by 50 basis points to 2.00%. Analysts are cutting their projections for corporate earnings and the ailing stock market amid concerns over the COVID-19 outbreak and the country's political uncertainty. CGS CIMB Research cut its end 2020 KLCI target to 1,497 points and sees KLCI earnings growing at a slower rate of 1.6% this year from 7% in 2019 before rebounding to 8% in 2021. The firm also cut its earnings projections for corporates under its coverage by 7% to 11.7% for FY20 and FY21. Affin Hwang Investment Bank, meanwhile, is reducing its 2020 KLCI earnings per share growth to 1.3% from 3.6%, underpinned by the cut in its GDP growth forecast to 4% from 4.5%. It is maintaining a neutral weighting on the KLCI with an unchanged year-end target of 1,540 points. Kenanga Research also lowered its year-end target for the composite, cutting it to 1,563 points from 1,712 previously. It is looking at EPS growth of 1.4% for FY20 and 5.2% for FY21. Dow Jones reports that Sime Darby's potential sale of its entire 30% stake in Tesco Malaysia could result in a 25-cent per share dividend for shareholders. Citing a research note by Maybank Investment Bank Research, the Newswire says the brokerage estimates that Tesco Malaysia could be valued up to $2 billion or 8.4 billion ringgit, and Sime Darby could gain up to 1.7 billion ringgit from its shareholding. Tesco, Britain's largest supermarket chain, has reportedly been looking to sell its business in Asia. Last month, it was said to have invited Thai tycoons to the second round of bidding for its operations in Thailand and Malaysia that could fetch a total of over $7 billion or 29.4 billion ringgit. Maybank Investment Bank is maintaining its buy rating for Sime Darby with an unchanged target price of RM2.58. Paramount Corp has set its property sales target at 1 billion ringgit for FY20, helped by some 1.2 billion ringgit worth of launches. This is despite missing its 1 billion ringgit sales target for FY19 by 308 million ringgit due to weak demand for its commercial properties. According to Paramount Group CEO Jeffrey Chew, the group had unbilled property sales of some 913 million ringgit as at the end of last year. Going forward, he expects to see a slow recovery in demand as buyers realize that property prices have hit bottom. In the next 5 years, he says Paramount is expecting its projects abroad to make up 10% of revenue. The group is looking at expanding in Thailand's capital Bangkok, Vietnam's Ho Chi Minh City, and Manila in the Philippines. MITI agency Malaysia Automotive Robotics and IoT or MARI does not expect the change of government to affect the third national car project under the National Automotive Policy 2020 or NAP 2020. This is because it is 100% privately funded. MARI CEO Datuk Madani Sahari says the project will therefore continue as long as there is interest from the private sector. On whether Maria expects any changes to be made to the NAP 2020 after the new cabinet is appointed, Madani says it is highly unlikely, since newly minted PM Tan Sri Muhyiddin Yassin was part of the previous cabinet when the policy was formulated.